During the last round of market chaos, tariffs, global tension, all the usual stuff, you would normally expect a rush of money into the United States, into the dollar and treasuries. That's what always happens. When foreign investors get nervous, they run to dollars and the US treasuries because it's the safest place in the world to park money. Except this time, they didn't. The dollar actually weakened and money started moving out of US assets. For the first time, investors weren't just shifting between stocks and bonds, they were starting to question the US itself. Now that's not supposed to happen, and it tells you something important is changing. This isn't about the debt ceiling drama you see on TV every year, where politicians pretend they might crash the economy if they don't get their way. That's just political theater. The real problem here is much bigger, much quieter, and honestly, a lot more dangerous because most people don't even notice it's happening. I'll show you why US debt is now a $40 trillion time bomb, what's about to happen to the economy, to jobs, and the stock market. Then, how you can prepare to save your financial life. Let's get the debt ceiling out of the way first because it's only a distraction. Every time we get close to that limit, politicians go on TV and talk about the hard choices and fiscal responsibility, and then at the last possible moment, they raise the ceiling because they have to. If the US ever actually defaulted on its debt, interest rates would spike, the dollar would fall, and markets around the world would panic. It would be chaos, so no, that is not going to happen. The whole thing is basically like threatening not to pay your credit card bill to prove you're responsible with money. Now that doesn't mean it's harmless. These standoffs have already led to credit rating downgrades and shaken the confidence in the US. But even that isn't the real issue. The real issue is what happens after they raise the ceiling and they just keep spending like nothing happened. Because the actual problem is the size and the growth of the debt itself. The US national debt is now pushing $40 trillion. That is 130% the size of the entire economy. To put that into perspective, we're back to levels we last saw during World War II. The difference now is back then we were financing a global war. Today, we're financing, well, everything. Social security, healthcare, defense, interest payments, tax cuts, it all adds up. And here is the part that really matters. Almost half of that debt has been added just in the last 5 or 6 years. That means this isn't something that slowly built up over decades. We hit that gas pedal and just kept it there. And I can tell you, over a decade working as an analyst on Wall Street, from an analyst point of view, that is the key. It's not just how big the number is, it's how fast it's growing, and right now, that growth is still accelerating. But then if this is such a big problem, why hasn't anything broken yet? That's the question everyone asks, and it is a fair one. If you've been hearing about the debt crisis for 20 years and nothing has happened, it's just easy to keep on ignoring it. It starts sounding like those warnings people keep repeating forever, like the market is overvalued or you should stop eating carbs. Now, there are real reasons we haven't seen a crisis yet. The US dollar is still the world's reserve currency, which means there's always demand for dollars and US debt. The treasury market is the biggest and the most trusted bond market in the world, so investors still see it as a safe place to put their money. And if things do get tight, the US can always print more dollars, which gives it more flexibility than any other country. Here, Japan is the example people love to point to. Their debt is over 200% of GDP, way higher than ours, and they haven't had a major crisis yet either. But this is where people miss the point. Japan didn't collapse, but they have had decades of slow growth and stagnant economy. That's not a win, that's just a different kind of problem. Not crashing doesn't mean everything is fine. It just means you're stuck forever, and that is where the US is heading. That's because the real issue here, folks, isn't just how much debt we have. It's how much it costs to carry that debt. The US is now spending $1 trillion a year just on interest payments, not on roads, not on defense, not on anything that helps the economy grow, just on the interest. That's more than we spend on healthcare, education, transportation, the police, and public assistance combined. Right now, interest costs are taking up to 20% of all federal revenue, and that number is still rising. As older debt gets replaced with new debt at higher interest rates, the cost just keeps going up. And here's the part that really matters. For every 1% increase in the interest rate, the government has to pay roughly $300 billion more per year. That's not a small number, that is a massive problem. It's at this point that the situation starts to look even worse. The government is borrowing more money just to pay its interest on the money it already borrowed. It's like juggling credit cards, and as long as the rate stays low, it works. But once those rates go up, things get a lot tighter very quickly, and it is happening right now. This is where it starts to affect the real economy. Every dollar that goes into government debt is a dollar that isn't being invested somewhere else. When investors buy those treasuries, they're not funding businesses, building houses, or creating jobs. Money is basically just getting pulled out of the productive parts of the economy. Over time, that's going to slow growth and reduce income. On top of this, there's the risk that things change quickly. Markets don't move in a straight line forever. They move slowly until they don't. In the bond market, one of the warning signs is something called the term premium, which is the extra return investors demand for taking that longer-term risk. When that goes up, it means investors are getting nervous. And we've already seen signs of that. Investors are starting to ask for those higher returns to hold that long-term U.S. Treasury debt. Big institutions are slowly shifting their portfolios. They're not panicking, but they are becoming more cautious, and that's how it starts. And if you want to see how fast this can all go wrong, look at the UK in 2022. The government announced tax cuts without a clear plan to pay for them, and within days the bond market reacted. Interest rates shot up, the currency dropped, and pension funds were forced to sell their assets just to stay afloat. The government had to reverse course almost immediately. That's how quickly confidence can disappear. Now, the US is in a stronger position than the UK, so this isn't happening overnight, but the process is still the same. If investors start to lose confidence, they demand higher interest rates. Higher rates increase the cost of that debt. Now, that makes the problem even worse, which leads to even higher rates. We've already seen the rate on the 10-year Treasury double over the last 5 years and stay stubbornly high even as the Federal Reserve cuts its own interest rate. With the 10-year at 4.3%, the housing market is frozen, the jobs market is getting crushed, and the economy is weakening. The danger here is the Fed can no longer control this by lowering rates. When this becomes a cycle, once it starts, it is impossible to stop. Now the question is, why don't we just fix this now? Well, because fixing it would require decisions that nobody wants to make. You can raise taxes, cut spending, or try to do both, but every one of those options affects voters directly, and politicians only care about getting re-elected. There are other ideas that people talk about, like growing the economy faster than the debt, or just letting inflation reduce the value of the debt, but those only work to a point. Growth would have to stay high for a very long time, and inflation comes with its own problems, like higher costs of living and higher interest rates. So then what do we do instead? We just keep on doing what we're doing. We run deficits, we borrow more, and we hope that something in the future is going to fix the problem. Nation, the longer this goes on, the more sensitive the system becomes. Debt gets bigger, interest costs grow, and even small changes can have big effects. That's when things start to matter more for everyday people. For consumers, this is going to show up in higher interest rates across the board. Mortgage rates, car loans, credit cards, these are all tied to those treasury yields. As that rate on the 10-year Treasury increases, borrowing gets more expensive, which slows down spending and growth. And for investors, it changes how the market works. Higher interest rates mean future earnings are worth less today, which hits those high-growth stocks harder. Companies that depend on that cheap money struggle, while companies with steady cash flow and strong pricing power tend to do better. And maybe the biggest issue here is just that the government has less room to respond to the next crisis. In 2008 and 2020, we used massive spending to support the economy. But if debt is already high and interest costs are eating up a big part of the budget, that becomes harder or impossible to do. You can't keep solving a debt problem by adding more debt forever. Now I'm going to show you how this affects you as an investor and the stocks to buy next, but if you haven't already, join me on the Blossom Investing app with the special invite link in the description. It's totally free to download, and besides seeing the stocks I'm buying in real time, you're also going to see what over 500,000 investors are talking about in the social feed. Again, it's free to use and helps support this channel, so I appreciate that. Look for the invite link below or just scan the QR code here. So what do you do with all this as an investor? You don't panic, but you do adjust. The world of ultra-low interest rates and easy money is not coming back anytime soon. Here, you want to focus on companies that can handle those higher costs and still grow. That means businesses with strong pricing power, solid cash flow, and less reliance on that borrowing. You also want to be more careful with those high-growth stocks that depend on those future profits because those are more sensitive to interest rates. Basically, this means that Warren Buffett playbook is back. Companies with strong cash flow now, not tech and not growth, promising cash flows in the future. You want stocks trading at a price to earnings of less than 10 times, those value stocks that are paying investors now in their dividends because as the dollar loses value and inflation runs higher, a dollar in the hand today is literally worth $2 tomorrow. It also means companies with assets tied to real cash flow, like energy, commodities, or dividend-paying stocks. Those become even more important in this kind of environment. And above all, you want to be flexible because this isn't a one-time event. This is a long-term shift. Right now, this is where it becomes something that actually matters for you because this isn't just some abstract government problem. This flows directly into the economy, into the markets, and into your portfolio. That means the first thing you need to understand is that we are moving into a world of structurally higher interest rates. That's not necessarily spiking overnight, but staying higher than what we got in the 2010s. That decade of near-zero rates was not normal. It was the exception. When the government is borrowing trillions of dollars and investors are starting to question that risk, they demand higher returns, and that becomes the new normal. Those higher interest rates change everything. And they change how stocks are valued because, again, those future earnings are discounted at that higher rate. They change how companies operate because borrowing money is more expensive now. And they change investor behavior because suddenly bonds start competing with stocks again. So your first shift is this. You want companies that can survive and even thrive in that higher rate world. That usually means businesses with a strong pricing power. These are companies that can raise prices without losing their customers. Think about companies like Coca-Cola or Procter & Gamble. If their costs go up, they just pass those costs on. People don't stop buying their toothpaste or soda just because those prices go up a little. That ability to protect margins becomes incredibly valuable when inflation and those costs are rising. Now, if you compare that to a company that has no pricing power, maybe a commodity business with heavy competition or a tech company offering a product that can easily be replaced, those companies get squeezed when those costs rise because they can't just raise their prices without losing customers. The second shift is around growth stocks, especially those high-growth tech. A lot of these companies are valued based on their profits that are expected years into the future. When interest rates are low, those future profits are worth a lot today, but when those rates go up, future dollars are worth less now. And that is why you see names like Nebius Group and Zoom Video Communications get hit so hard when those interest rates rise. It's not just about their business, it's about how those future earnings are valued today. Now, of course, that doesn't mean you avoid growth entirely. It just means you have to be more selective. The companies that survive are the ones that can turn that growth into real profits and real cash flow, not just promises of that growth 5 or 10 years down the road. Which leads us to the third point. Cash flow matters more in this kind of environment. Companies that generate strong, consistent cash flow become more valuable because they don't depend that much on their borrowing or their future projections. That's why you often see investors rotate into those dividend-paying stocks or those more mature businesses when rates are higher because their cash is king. Here, for example, companies like ExxonMobil or Chevron generate massive cash flow, especially when those energy prices are strong. They can pay dividends, buy back their shares, and invest in their business, all without needing that cheap financing. That makes them resilient when borrowing costs rise. And the fourth shift is towards real assets. When inflation is higher or more unpredictable, assets tied to real-world demand tend to perform better. That includes energy, commodities, infrastructure, even certain types of real estate. These assets have value that isn't just based on future expectations. They're tied to physical demand. The bottom line here, folks, is the US isn't about to default, and we're not waking up tomorrow to a financial collapse. But that doesn't mean everything is fine. The debt is growing, the cost of that debt is rising, and the long-term effects are starting to build. I'm not going to sit here and try to scare you just for the drama. This isn't a sudden crash story. It's a slow change that reshapes the economy over time. By the time most people feel it, though, it's going to be already too late. So no, the crisis isn't here yet, but the conditions for it are building year after year, trillion by trillion. That's exactly why you don't want to wait for the headlines to tell you it's a problem. You prepare for it before it becomes one. Join me on the Blossom app with the special invite link below and see the stocks I'm buying in real time. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.